Hidden risks of RRIF withdrawals. Turning your RSP into a RRIF might seem like another checkbox on your retirement to-do list. But here's the truth. Once those withdrawals begin, a whole new set of challenges can creep in quietly and often without warning. You might assume the only risk is paying a bit more tax, but the real danger, you can unknowingly trigger a chain reaction that affects your government benefits, increases your long-term tax bill, and even reduces the inheritance your family receives. In fact, many retirees don't realize until it's too late that the size and timing of their withdrawals can push them into a higher tax bracket, trigger OAS clawback penalties, force them to withdraw more than they actually need, and leave their estate with a massive tax liability. The good news is, these risks are avoidable, but only if you understand them in advance. So in this video, we're breaking down the 5 hidden risks of withdrawals, and I'll walk you through the planning strategies I use with clients to help reduce unnecessary taxes and keep their retirement income on track. Let's dive in. Hi, if you're new here, my name is Charles Lacalzi, Associate Investment Advisor at IA Private Wealth, Zenith Private Wealth Counsel. If you find this helpful, be sure to like this video and subscribe to the channel for more Canadian tax and retirement strategies. Part 1. Withdrawals are fully taxable and often mistimed. When you convert your RSP into a RRIF, the government doesn't just encourage you to withdraw funds, they require it. Starting in the year after you turn 71, you must begin taking minimum annual withdrawals calculated as a percentage of your account balance and your age. At 72, the rate is 5.28%. By 80, it's 6.82%. And by 90, it jumps to 11.92%. And every dollar you withdraw is fully taxable as regular income. Now here's the problem most Canadians run into. They treat RRIF withdrawals like an afterthought, assuming that because they're retired, their taxes will automatically be lower. But that's not often the case. Let's look at a simple example. Imagine someone named Linda who just turned 72. She's receiving $1,100 a month from CPP, $700 from OAS, and a $1,500 monthly pension from her old employer. That's about $3,300 per month, or just under $40,000 a year in regular income. Now her RRIF is worth $500,000, which means the minimum withdrawal this year is 5.28%, or about $26,400. So in total, Linda is reporting $66,400 in taxable income. Depending on the province she lives in, she could owe between $11,000 and $14,000 in combined federal and provincial taxes, just from her standard retirement income. And if she needs to withdraw more than the minimum for a one-time expense, that tax bill could easily be. Here's where the timing matters. If Linda had taken smaller RSP withdrawals earlier in retirement, when her income was lower, she could have reduced her future RRIF balances and avoided pushing herself into a higher tax bracket now. Or, she had withdrawn strategically between the ages of 65 and 71, she could have taken advantage of pension income splitting and the age amount credit, which starts to phase in at age 65. But instead, because she waited until the RRIF withdrawals became mandatory, her flexibility is gone and her taxes are going up. The key takeaway here is this: RRIF withdrawals don't just create income, they create taxable income. And if your CPP, OAS, pension, and RRIF aren't coordinated properly, you could be paying thousands more in tax each year. And this is part 2. The OAS clawback risk gets overlooked. One of the biggest blind spots in retirement income planning is the old age security clawback, officially called the OAS recovery tax. So here's how it works. If your net income in retirement goes above a certain threshold, the government starts to claw back your OAS payments. For 2024, that threshold is $90,997. For every dollar you earn above that amount, you lose 15 cents of your OAS. And if your income gets too high, around $148,000, you lose the benefit entirely. Now, at first glance, many retirees think, well, I won't own that much in retirement anyway. But here's the trap. RRIF withdrawals count towards your net income. So if your RRIF is large, or if you make a one-time withdrawal or something important, you could accidentally trigger the clawback. Let's look at another example. This time with someone named Paul. Paul is 73 and has a RRIF worth $750,000. That means his minimum withdrawal for the year is about $39,600. He's also receiving $13,500 from CPP, $8,500 from OAS, and $25,000 from a workplace pension. That brings his total income to over $86,000 before even considering investment income from his non-registered accounts, which could easily put him above his OAS clawback line. Now, Paul's car breaks down and decides to withdraw an extra $15,000 from the RRIF to buy a new one. On the surface, it's a smart move. He's using his own money. No debt, no financing. But that $15,000 withdrawal just pushed him over a total income of $100,000 for the year. As a result, he will lose part of his OAS benefit and pay higher tax on the withdrawal, turning a simple car purchase into a costly financial decision. This is what makes the OAS clawback so sneaky. It's not a tax bracket, it's a penalty on your government benefit, and it can catch people off guard, especially if their income varies year to year, or if they are unaware that all forms of taxable income count, including RRIF withdrawals, capital gains from selling investments, interest and dividends, rental income, or even part-time working or consulting. So what can you do about it? We'll get into strategies later in this video, but one of the most effective ways to avoid OAS clawback is to smooth your income over time. Instead of allowing big spikes caused by large RRIF withdrawals, because once you cross the threshold, the cost isn't just a higher tax bill, it's losing a valuable government benefit that you've spent your entire working life earning. Part 3. You might be withdrawing more than you need. One of the most frustrating realities for retirees is this. Once your RSP becomes a RRIF, you don't control how much you withdraw, at least not the minimum. Every year, the government sets a required minimum withdrawal percentage based on your age, and that percentage increases as you get older, whether you need the income or not. Here's a snapshot of how it works. Age 72, 5.28%. Age 75, 5.82%. Age 80, 6.82%. Age 85, 8.51%. Age 90, 11.92%. Now, that might not seem like much on paper, but when you apply those percentages to a sizable RRIF, you can start to see the problem. Let's take an example. Mary is 80 years old and has a RRIF worth $600,000. Her required minimum withdrawal at that age is 6.82%, which means she must take about $40,920 this year, whether she likes it or not. But Mary's living expenses are modest. Her CPP, OAS, and a small annuity already cover her needs. She only really needs $20,000 a year in supplemental income. That means she's being forced to take out double what she needs and pay tax on the full amount. And the leftover funds, if she doesn't spend them, they get invested in a non-registered account where she might pay even more tax in the future. She might pay tax on interest income, taxed at her full marginal rate, capital gains when she sells investments, dividends from Canadian stocks, which still increase her taxable income. In short, she's losing control over the tax efficiency of her retirement income. Here's the bigger issue. Forced withdrawal means your income increases even if your expenses don't. That can cause higher tax bills, loss of income, tested benefits like OAS or the age amount credit, greater exposure to inflation risk if taxes are a bigger bite out of the fixed income. Many retirees assume they'll be in a lower tax bracket later in life, but that isn't always true, especially if your RRIF balance is large and you're forced to draw more every year. And remember, by the time you hit your late 80s or 90s, you could be withdrawing 10% or more of your RRIF each year, again, even if your spending is going down. So what's the solution? You'll see in the strategy section coming up, but it all starts with proactive planning. If you're in your 60s and not yet drawing from your RSP, you may have more flexibility today than you will in the future. The more you can smooth your withdrawals and manage your tax brackets, the better position you'll be to preserve wealth and avoid these compounding risks. Part 4. Your RRIF can create a major tax liability at death. There's a common misconception that once you build a solid retirement nest, your legacy will automatically be protected. But for many Canadians, a large RRIF balance can actually create a significant tax burden at the worst possible time. Here's why. When you pass away, any remaining funds in your RRIF are treated as fully taxable income on your final tax return, unless you've named the spouse or qualified dependent as a successor or beneficiary. This means the entire balance is added to your income in a single year, which can easily push your estate into the highest tax bracket. Let's walk through a scenario. Imagine George passes away at age 84 with a RRIF worth $700,000. He's widowed and his children are listed as the beneficiaries. Since there's no spouse to roll the RRIF over to tax-free, the entire $700,000 is added to his final income for that year. That alone may push the estate into the top marginal tax bracket, which can exceed 50% in provinces like Ontario and Nova Scotia. The result? George's estate could face a tax bill of $350,000 or more just on the RRIF. Even though he worked hard to build those savings, more than half could be lost to tax, reducing the legacy he planned to leave behind. Now, some people think they'll just spend it down before they pass away, but that's easier said than done. In many cases, RRIFs continue to grow throughout retirement, especially if you're only withdrawing the minimum and the portfolio performs well. So unless you have a drawdown strategy in place, there's a good chance you could reach your 80s with hundreds of thousands of dollars inside your RRIF and a growing tax liability to match. This issue also impacts charitable intentions and estate equalization. If you plan to leave money to your kids and grandkids, the RRIF tax bill can significantly reduce their inheritance. If you have one child receiving the RRIF and another receiving non-registered assets, the after-tax amount could be dramatically different, causing unintended conflict. If you want to leave a portion to charity, you'll need a structured plan to maximize the tax credit and minimize the estate's tax burden. If you don't plan for the eventual tax hit on your RRIF, you may be leaving a surprise for your family and not in a good way. But the good news is, with the right strategies, you can reduce this burden significantly and in some cases, eliminate it entirely. That's exactly what we'll cover in the final part of this video, part 5. What can you do to reduce these risks? Now that we've looked at the major risks RRIF withdrawals can create, higher taxes, OAS clawbacks, excess income you don't need, and estate erosion, it's time to focus on the solution side. Because while these risks are real, they're not inevitable. With proactive planning, you can reduce your lifetime tax bill, improve your retirement income efficiency, and protect your legacy. Here are 5 handy strategies to consider. The first one, start strategic RSP withdrawals before the age of 72. If you're in your late 60s and not yet collecting OAS, it may actually make sense to start drawing down from your your RRSP early, even if you don't need the income. Why? Because this gives you an opportunity to withdraw at a lower bracket, especially if you're no longer working and have started CPP or pension income yet. By reducing your RRSP balance now, you can shrink the eventual size of your RRIF, lowering your future minimum withdrawals and reducing the odds of triggering an OAS clawback later on. Plus, the income you take out can be redirected into a TFSA where future growth is completely tax-free. 2. Use income splitting after age 65. One of the most powerful tools available to retirees is pension income splitting. Once you're 65 or older, you can split up to 50% of your RRIF income with a lower income zone. This can lead to lower combined household taxes, avoiding OAS clawback, potential eligibility for tax credits like the age amount or pension income credit. Let's say your RRIF withdrawal for the year is $30,000 and your spouse has minimal income. By splitting $15,000 of that with them, you might reduce your tax bracket and theirs, saving thousands as a couple. This is a highly effective strategy that many Canadians overlook. 3. Reinvest RRIF withdrawals in a TFSA. Forced to take out more than you need? Don't just let the excess sit in cash or a taxable investment account. Put it to work tax-free inside your TFSA. As of 2025, the annual TFSA contribution limit is $7,000, bringing the lifetime contribution limit to $102,000 for individuals who have been eligible and maximized contribution since 2009. Let's say you're withdrawing $25,000 from your RRIF, but only need $15,000 to cover expenses. You could contribute the extra $10,000 to a TFSA if you had room, where it can grow and be withdrawn without ever affecting your taxes or OAS eligibility again. This is one of the simplest, most flexible ways to preserve tax efficiency in retirement. Number 4, consider making charitable donations from RRIF income if giving is part of your values or legacy plan. Consider using RRIF withdrawals to fund charitable donations, especially later in life. Why? Because donations can generate tax credits that offset the tax from your RRIF income. This is particularly effective in your later retirement years when RRIF withdrawals increase. You can also structure gifts in your will to leave part of your RRIF to charity, which helps offset the final tax bill your estate might face. Charitable giving, when aligned with tax planning, can be a powerful win-win. 5. Use permanent life insurance to offset the tax liability. If you're concerned about the tax burden your estate may face from a large RRIF balance, one option is to use permanent life insurance to replace those tax dollars. Here's how it works. You calculate the estimated tax your estate will owe on the RRIF. Then you purchase a life insurance policy with a death benefit that covers all or part of that amount. On your death, the RRIF is taxed, but your heirs receive a tax-free payout from the insurance policy, effectively neutralizing the loss. This is especially helpful if your goal is to equalize your estate among beneficiaries or to preserve wealth across generations. In some cases, business owners may be able to structure this within a corporation for added efficiency, but this is a complex area that requires advice from a tax and legal profession. So here are your key takeaways. RRIFs are a powerful tool, but without planning, they can create more problems than you would expect. It's not just about converting your RRSP at age 71. It's about coordinating your income, benefits, tax brackets, and estate plan year by year, so your RRIF withdrawals serve your goals, not sabotage. If you'd like help applying these strategies to your own situation, click a link in the description to book a time with me or someone on my team. We'll take a look at your full retirement income picture, your RRSP, TFSA, pensions, and estate goals, and help you build a plan that protects your wealth for the long term.